Welcome everyone to the Traders Desk. We are on the 22nd of June 2025. Before we get started, this is not financial advice. This is purely for educational basis. And do read the disclaimer along with the copyright notice. So, quite an interesting week, right? A large part dominated again by the hostilities in the Middle East. So things have escalated quite significantly towards the end of the week and over the weekend, especially last night. The US have conducted some operations in Iran. Um, it remains to be seen how the market will perceive this, whether they will think this is highly escalatory or whether they would think that, the US has probably taken away all the cards that Iran has. I think it's going to be the former, but we can never tell, right? Looking at the situation, I think it's basically adding fuel to fire. Um, we're not exactly sure whether the operations by the US has in fact done anything. Um, you know, they normally call these bombs bunker busting bombs, but we have no evidence, no footage, no statements that actually are credible enough to give us a good indication as to whether Iran has been hit significantly by these operations. Um, some part of me believes that this is kind of it's kind of a show that's been putting on. Um, but what do I know, right? At the end of the day, we care about what this does to the risk of sentiment in markets. And unfortunately, we have to pay attention to these situations that are happening because it impacts the way risk gets priced into the market. So let's look at a few charts. On the S&P side, again, another week. Um, it's the second week of the S&P falling. We're not too far from the all-time highs. So that's, we've had a number of weeks of strong performance and we've gone back very quickly into the bull market territory. So it looks like the market is taking a little bit of a breather now. Not surprising given the V-shaped recovery that we've gotten, but also given all the risk of sentiment. Issues around war, issues around inflation, lots of other things, including trade deals that are not yet concluded. So all of this is kind of putting investors on the sidelines. I mean, if you think about it, it's very hard to deploy capital at the moment, whether it's for businesses, whether it's for investor uh, or market participants, right? A wait and see approach makes a lot of sense until we've got clarity on many of the policy decisions. I don't think we'll see meaningful deployment of capitals at the industrial level, at the investor base level either. So I think that's what's happening. I would not be surprised to see the market pull back quite a bit from here. I think the next stop might be the 200-day moving average. But we don't really care because we have a diversified portfolio of longs and shorts, right? But it's nonetheless important to understand which way the market is heading and to adjust our portfolio biases accordingly. On the right, we've got the Magnificent Seven. So this is a chart we've been tracking quite a bit, especially towards the start of the year. Um, we are seeing a little bit of exhaustion signals within the Magnificent Seven. Again, a lot to do with the risk of sentiment. Um, keep watching it. I'm not going to read too much into this, but keep an eye on this. These guys have been the leaders in terms of the recovery of the S&P 500 and the Nasdaq 100. So if they start going down, I think this recovery could have a significant pullback. And then The next one that we'll look at is the equal weighted version of the S&P 500. So again, we look at this just to get an idea of how the breadth across the stock market is. And again, we're seeing a bit of weakness. It's been held by the 200-day moving average. Um, I would not be surprised to see next week showing us a bit more direction, and that's probably going to be downwards. So breaking through the 200-day moving average. Um, we're still not getting confirmation that there's a major sell-off happening, but we're definitely seeing a lot of exhaustion signs. The market stalling in many ways, right? Um, when it comes to these situations, sometimes you just keep it at the back of your mind and then wait until you get actual real confirmation signals. Um, we saw this. I mean, the great thing about looking at this is that we've done exactly the same thing around February and March, right? So we started getting short sometime mid of Feb. And then as we got confirmation towards the end of Feb, even start of May, start of March, that's when we really started, increasing sizes and getting significant short exposure in the portfolio. So just a reminder, when you're trading options, there are different ways to increase your exposure. One is you have more positions, so you allocate more dollars to the short side of your portfolio. So, for example, if you typically run a 10 position portfolio, five longs, five shorts, you could do six shorts, four longs, right? That extra position gives you that extra net short bias that you're looking to add in your portfolio. But you could also be clever with your structuring. If you foresee that you could be looking at a significant sell-off, you start structuring your trades a little bit more aggressively, especially when you're looking at your tail risk trades where you think there's a big potential for the stock to move. Um, I'm sure you understand what I mean. It's basically saying try to go slightly out of the money. So when the market really moves in your favor, your return on investment is very significant, right? Whereas typically what we would tend to do is not be too far out of the money, right? Because we don't want to get caught out if the market has like a couple of good weeks, and then we'll just end up with a lot of our premium expiring just because we got in at the wrong time, right? So that's how you think tactically about these situations. Of course, it's very easy to say this on a webinar, but when you actually have to do it in a live setup, it's a totally different ball game. So that's kind of the muscle that you have to start training, and always look at these situations from that perspective, right? It's clear that we're not going to have another massive bull run. I don't foresee this at this point in time. We're having a little bit of a pause within this V-shaped recovery. So maybe for the next 4 weeks, you don't want to be aggressive with your longs, right? You can still have, let's say, five longs. You can still have one position that's aggressive, but the remainder four, just be very sensible. Don't be like too far out of the money, and make sure that you're looking at the portfolio from that perspective. Let's move on from this. Let's look at the US 10-year yield. So it's come down a little bit. That's in line with the inflation measures also tapering. So that's been quite interesting. So far, we haven't seen a resurgence in inflation despite the tariffs. Of course, the tariffs are not yet finalized, but our view is that finalized tariff numbers will be lower than what the current numbers are at. Or, it would not be like two, three times higher than what they're currently at. Of course, that's a surprise element, but our base view is that we'll either, let's say, get to the same level of tariffs or slightly lower. And with that in mind, um, I don't think we have a setup where we could have like massive inflation linked to the tariff only. However, when we're looking at what's happening with the hostilities in the Middle East, we have to be very careful because the price of oil is rising quite significantly, and there's a lot of upside risk to that. So the price of oil can go another 5, 10, $20 in the space of a couple of weeks based on how this hostile situation will develop. So this has a big impact on the price of diesel, gasoline, and many other raw materials like petrochemicals and so on. Um, and CPI will definitely inflect upwards if these moves stay elevated, right? So if the price of oil stays above $80 and beyond, I think we will be staring at a little bit more of an inflationary environment in that situation. And anyway, war tends to be inflationary, and that's not just because of the price of oil going through the roof. It's also because of all the disruption it causes. It's because of all the deficit spending that governments have to do, not just in the US. Uh, Many parts of Europe are remilitarizing. So Germany has a massive defense budget that they're already implementing. So all that money is going into the economy, and it's creating a lot of inflation, or it's not necessarily creating a lot of inflation now, but it's sowing the seeds for creating inflation continuously over the next few months or even years. So we have to keep that in mind and keep looking at the data as it comes. Always be flexible in your thought process to change your view if the data invalidates what you were previously thinking. So we also had the Fed meeting in the middle of the week. I've discussed this a little bit in the Discord server, but the highlights were that they reduced the estimate for GDP growth from 1.7 to 1.4% in 2025. And the 1.7 was already a little bit of a downgrade from the previous quarter. So the Fed is seeing the economy slowing, but they still mention that it's healthy and economic activity is healthy, and there's not really a lot of cause of concern from their perspective. Um, Aside from that, we also got the dot plot, which I'm not going to discuss here, but it looks like the Fed is probably going to, as they mentioned, adopt a wait and see approach and see how the situation in the Middle East develops alongside how these trade deals come through, and then eventually make a decision as to whether they will cut or not. I think they have the luxury to wait because the job market is still holding up, and at the same time the economy is not cooling down significantly. So there's no, from the Fed's perspective, there's no reason to be a hero and take extra risk and try to foresee way ahead of time and then get it wrong. Okay, let's move on to some sector performance moves. So um, quite an interesting week, right? Of course, energy outperformed all the other sectors, and then we've had a bit of a sell-off. One would have thought that industries like utilities and healthcare would be doing well by virtue of being defensive in defensive sectors, but that's not really been the case, right? Healthcare is the worst performer, and this is a theme that has been developing for a long time, right? I still believe there are good opportunities to have within this sector, but it's something that requires a lot of analysis and a lot of bottoms up analysis, right? There are regulatory changes that have been proposed and that will be proposed in the future. So one has to be careful of this and not get caught up with companies that could have significant regulatory risk ahead of them. Yeah. Um, Not much else to discuss, right? Consumer discretionary, not having the best of weeks. It's now down 2.4% or 2.5% on the month. So it's definitely been correcting from, the last month. Before that, it had like a significant recovery. So it's been the leading sector for a number of weeks, and now it's basically cooling off. I think there are opportunities within this space too, especially as the potential for consumer sentiment improving from here remains elevated. Of course, there are risks like the Middle East hostilities, inflation coming back. A lot of people might become, a lot more defensive with their spending. And in the sentiment surveys, you'll start seeing that being echoed. Um, so we have to see where this will go, right? But at the same time, we also have jobs holding up. Um, we also have a situation that I have not discussed yet, but we could be heading into an environment where the home prices are starting to not crash, but fall, right? So there's a little bit of correction happening. Places like Florida, for instance, have already started seeing meaningful declines in home prices. Um, how will this impact consumer discretionary? Well, we all know that US home buyers have a lot of equity in their homes. And as these home prices come down, the equity will also come down. So these guys, they wake up thinking that they have a lot of equity, and then we suddenly move into an environment where every day they're thinking, oh, the equity is declining, and there is a risk that at some point I will not be able to crystallize the equity and get something out of it. So typically, how do you take advantage of the equity or the home equity? You could refinance, or you could take an additional loan, assuming that new home price, which is slightly higher than what was used in the previous assessment. So you could do HELOCs. So this is basically where you get an extra loan on your house. You could sell the house, right, and then just crystallize that home equity into cash. So as the home prices start correcting, I think there could be a lot more selling pressure, which just makes this whole cycle uh, get a lot stronger. And with that, what all I'm trying to say is people's wealth effect would be significantly decreased. At the same time, if we have a fall in the stock prices, that's another area where the US consumers have a lot of exposure. So a combination of home prices falling, stock prices falling, can very quickly tip sentiment negatively. And this is something that we need to keep watching for, right? Because consumer discretionary or consumer sentiment has been holding up. And these are the guys that have kept the US economy growth going, right? So we could be at a very important uh, junction in the economic cycle and even in financial markets. We don't know yet, but these are the things that we need to start watching for. So as an example, what am I doing in consumer discretionary? I'm starting to look for a few turnaround stories. Um, I've got a couple which I think I'll mention in the Discord server. I'm not going to discuss it here in the free video. Um, but yeah, we'll discuss it later. And then let's look at the outperformers. So financials had a good week after, a bit of a difficult month. But again, financials, I think they sold off a little bit from a profit-taking route, but also, a lot of fears around GDP slowing down, and the deregulations not coming quick enough. So I think all of these, if you put that in the balance, that's probably what you're seeing in the price action. Um, I think there are great opportunities within the financial space. Even within financials, you have some segments that could be considered defensive. So, for example, some insurance segments. I know we looked at a company called Ryan a few months ago. Um, that company, um, it's in a segment that, probably will still keep booming. So it's predominantly B2B, not consumer based. So it's got a little bit of protection from that perspective. Um, a lot of these covers are mandatory, or even if it's not mandatory, it's not something that people would want to operate a business without having proper coverage. So I think we need to look for opportunities like these. And the way to go about it is to always do more research, widen your knowledge base, and then you'll find all these opportunities springing out fairly easily. Not much else to discuss on this. I'll move on to the industry performance. So quite interestingly, we're getting a resurgence in the retail sector. So if you look closely, it's up 3% on the year, it's up 0.6% on the month, and then on the week, it's up 2.2%. So is this something to take seriously and go long at this point in time? Probably a bit premature, but it's not something that we can just cast aside, right? It's possible that we're seeing green shoots within this industry. And when we look at the price action in this manner, it forces us to start looking a little bit more in depth and understanding what's happening within the industry. So I think a large part of it is linked to a significant sell-off that's happened in that space. Um, and now investors are probably seeing a little bit of, they're becoming bargain hunters and deploying capital from that perspective. Alongside, you have a slight improvement in the consumer sentiment. And it's likely that a lot of these companies have reported and the earnings have not been as bad as feared. So, from our perspective, we care about this because, if there is a significant re-rating potential here, at least want to participate in a couple of these situations. Um, in terms of the worst performers, solar, gold miners, uh, you know, quite a big sell-off on the week. Solar, I think it's no surprise. We've been talking about this. This space is it's got a lot of regulatory risk. It's also got a lot of companies that are not properly run. Um, a lot of legal action pending on many companies. But interestingly, for the gold miners, so over, I think it was yesterday, I was thinking of writing something in the Discord server. So you know how we discuss pain trades all the time, right? Uh, is shorting gold or gold miners a good pain trade? I would invite you to unmute and explain, what you think about this particular pain trade. Is it a pain trade to start off with? Go for it. Don't be shy.
I think it is definitely a pain trade if you're shorting gold miners
So why would you think it's a pain trade?
because of the crowded
Hmm. So
investors inside the golds.
the narrative over the last year or so has been that gold is the safe haven asset for inflation and all of that. I'm not dismissing it. So people have been buying a lot of gold, and that's caused the prices to go quite high, right? On top of that, you've got the geopolitical risk escalation. So that's also contributed to that. You've had central banks buying gold. So all of that have already happened, or what I'm trying to say is in the future, these things might not happen to the same extent. But the price is kind of assuming that this will keep going, right? So what happens if one thing to understand also is that the price of gold has a very strong relationship with inflation, but also interest rates. More predominantly, real interest rates, right? So if you take interest rates where they're at minus inflation, that gives you the real interest rate, right? And now, if the Fed is saying that they will not cut anytime soon and they'll wait a little bit to get more clarity, as you have more disturbance in terms of war or trade deals getting delayed and so on, you're just pushing that timeline much further. You're creating a lot more uncertainty for the Fed, right? So, um, could we have gotten to this position where gold goes to 3,300, whatever, because people are expecting a Fed cut and then that doesn't come, right? So a lot of people are positioned long. A lot of people are positioned long in a very passive manner. So they've just heard from their neighbors that they need to buy gold or have 5% of their portfolios in gold. And they're not necessarily on the ball, right? So there could be a significant potential of a pain trade here if, let's say, for example, the war situation is resolved in the Middle East. So that's one way to protect yourself, right? Let's say you're long oil or oil stocks, hoping that or planning for a situation where the escalation will get worse. As a hedge, being short gold or gold miners might be a very good pain trade to kind of counter that risk on the other side. So that's kind of how you need to be thinking about it. At the end of the day, you're trading risk, right? And you're always trying to structure the risk in a way that it gives you an asymmetric return if the event that you're looking at or trying to protect yourself from happens, right? So if the gold miners are down nearly 4% on the week, I guarantee you some are down 8 to 10% at a stock level, right? And if you had found them, and if you know how to do your research, many of them have operational issues where costs are just going through the roof, and they're probably even mining uh, lower quality gold or lower volumes of gold. So, the revenue growth is not coming through, costs are increasing, margins are getting cut, EPS probably stagnant or even going lower. And with that, if you have a small correction in the price of gold, I'm not saying gold will go to 1,500 or $1,000. That's not what I'm saying. But if you only have like gold selling off by 100, $200, these gold miners will move quite significantly down, right? So that's how you think about these situations. And then you set out, do your research, figure out whether this is a situation where you can probably stack your odds in your favor by picking the right companies. So, it's also possible that the gold price doesn't fall, but that particular gold miner that you've picked sells off quite significantly on the basis that its fundamentals are weakening. And these moves will tend to be quite exaggerated because a lot of people are lazy longs, right? They've just piled into these gold miners. So for instance, if you're just buying GDX, you're getting some exposure to Barrick Gold, Newmount Gold, a few other gold miners. You haven't necessarily picked them, but you've got exposure to them. So that's lazy long situation. And we always look for these situations to try to skew things into our favor. Um, I think that's probably all I wanted to discuss. You know my view on home builders, right? So we had like another bad print of the building permits this week. I think this is probably what sets a whole chain of events in a negative territory. So we need to be paying attention and, start doing our research again from a value chain perspective and then identifying who are the guys who are going to be the next victims. I've discussed a couple of ideas. This is a theme that's not new to us. We've been discussing it from June of last year and more accurately or more closely in January, February. Now, I think, attention will come back to this theme and we need to be there positioned to, just make sure that all the research pays off, right? Do we have any further questions before I move on? No questions, right? Uh, yeah. Also quite interesting to see that oil services were down on the week, right? What does that tell you? Producers are up whilst oil services are down. That's not supposed to happen, right? So it's probably telling you that the investors don't believe that the price hike in the oil sector is going to be sustainable. They probably think that this is just a couple of weeks bump and then it will come back to 70 and even lower. Because oil services, these are long-term contracts, right? It's not trading on the basis of next week's crude oil price, right? Does that make sense? Anyone?
Yes,
Okay,
makes sense.
cool. Um, I think oil services, as we're getting a rally in the oil price, it's probably time to start doing your research from a short perspective, because inevitably, as the price of oil goes up, this will also start reacting. But also only if your view is that eventually, oil price corrects back to 70 and below. Uh, that's my view. But then the hostilities can last for much longer. And we can also have a resurgence in China, economic activity, India, and so on. So these are big consumers of oil. But at the moment, doing research never hurts anyone, right? Even if you have to go long later on, you know a couple of companies, and it's not going to be very difficult for you to figure out the right candidates to go long and short. Okay, moving on. Let's take a look at what the market did from a factor perspective. So it's been a good week for mid caps after many, many weeks of underperformance or severe underperformance. So the mid cap space altogether is seeing an influx of capital. I think, again, that's probably bargain hunting. A lot of companies within the AI space or the AI value chain have moved up a lot, and these companies tend to be within the mid cap growth space, right? Uh, Again, we're seeing a little bit of risk on behavior within mid caps and small caps. So that's good to see because this indicates that the market is forward looking in terms of growth expectations within these spaces. Um, Large cap growth had a bit of a sell off. So that's probably a bit of capital rotation happening here. So money has been moving from the large cap segment into the smaller cap spaces, predominantly mid cap and then the small cap space. So it's a weekly performance, so not much to be read within that, but just keep that at the back of your mind. Um, if you want, you can look at the monthly performance. Mid caps are still fairly down on a monthly basis. small caps too, and then large cap growth are still outperforming from a monthly perspective. But I suspect we could have a few more weeks of whatever we've seen with mid caps and small caps attracting capital, especially as the market gets a little bit more risk on and goes in search of growth and so on. Okay, last slide, and then we'll move to the paid presentation for the Discord server. Um, just a quick one on corporate bond spreads. So, not much of a change. We still have elevated spread levels. It's just something that we need to keep an eye on. Um, at the moment, let's put it as a little bit of an amber signal. We don't know which way this is gonna go, but it's important for us to keep an eye on this because if this keeps rising, and if it rises fast, we're gonna see a bit of a sell-off within the markets, the equity markets rather. Okay.